Yo, good morning guys. This one I'm taking today. This is percentage. Tomorrow, so I'm good to go for streaming. So that's what I'm taking out of this morning. Let's go. Let's play this possible. Let's check the open news. About 10,000 right now. Let's go.
Don't forget, we're just starting the last week of the first quarter, and March in itself has been quite troubling for very obvious reasons. We are all quite versed in geography, and we do know that physical pipelines get us that far. So naturally, with the disruption that we have been seeing from the geopolitical developments, there have been some places in the world that have been feeling more the adverse impact of what's been happening. You mentioned downgrades, growth downgrades, and it's worth highlighting what we've heard last week from the OECD, that there's a high level of uncertainty around the duration, the magnitude of the current conflict in the Middle East, and that means that growth outlook is subject to significant downside risks that could result in lower growth and naturally higher inflation. So again, EM is not immune to what's been happening now, but again, it's been more resilient relative to what we have been witnessing in previous episodes, for sure.
Yeah, so let me ask you about that resilience, because even though we've had a tough March for various EM assets, a number of people have been pointing out that the fiscal picture for emerging markets, certain governments in the emerging market space, looked a lot better coming into this war, into this crisis, than it did in previous testing episodes. A lot of self-help measures have been taken, a lot of house cleaning, if you like, when it comes to debt levels. Is that a story that you think emerging markets are now benefiting from there?
Absolutely, it's not just a story, it's the reality of the EM, and that ties to exactly the point that traditionally what we would look into EM is the ability to prevent any sort of capital flight. Geopolitical tension as navigating at the moment, and policy normalization. What we have been seeing since the end of February with the geopolitical developments is a combination of the two. You have been seeing the repricing of the front end in terms of hikes in DM, but also it's a natural byproduct that we have been seeing also in EM. Tying back to the things that we have been discussing about the evolution relative to the previous cycles, one another key point make that when compare where we, for example, 2024, we met many central banks, many of the authorities lifting effective reserves. These days, what we have been seeing is the exact opposite. We have been seeing replenishing of FX reserves, which is effectively very high, and which is effectively what we have at our disposal in times of stress. This is what we have been seeing now put forward in order to be at a better state.
So, is now the time to buy EM credit and local bonds, or is it better to kind of wait till some more of this volatility has passed?
It's actually always the time to buy EM, as long as you know where to invest, as long as you do your homework, and as long as you know what is the state of the business cycle across the different aspects of the EM. Don't forget EM is not a monolith, it is not just one facet of what you're seeing. So naturally, with what we have been navigating, what you're seeing is leaders and laggards. You have been seeing economies that they're more tied to the upside of what's been happening, equally economies that they're tied more into the shock, the negative shock through the returns of trade impact. So what I would say is, as long as you know where you're investing and what is the risk that you're getting, and especially has been an asset class that has been quite undervalued, then yes, certainly there are pockets that you should explore.
But how much of the EM debt story right now is about Fed policy? How much of it is about, the sell America trade, the desire to diversify away from US assets?
Well, no one can shy away from what is happening in the US. No one can shy away from what is happening in Fed. Whether you're talking about DM rates, whether you're talking about EM rates, whether you're thinking about sovereign, corporates, local currency exposure. But what we have been seeing certainly is tailwinds, positive tailwinds, especially manifested, for example, in Asia, part of the world through the AI, artificial intelligence, that have been helping a lot and has been offering some buffer on what is happening at the moment. But going back to your point, there is an interlinkage, but certainly there have been discussions about what is the state of the US economy, and certainly it has been proven more resilient than expected. And in the end, equally, we have economies that have been proven extremely resilient, extremely strong. So, yeah, to your point, it is an interlinkage. But there are also a lot of idiosyncratic stories that are playing in the end.
And let me ask you about some of the more negative areas of the EM space, Elena. You've talked about the resilience, and you've talked about how there are always reasons to buy if you're selected. Where are the areas you want to avoid? Those with more exposure, I imagine, to the higher energy costs and the strength of the dollar and the weakness of their own currencies. So where would that put the spot?
You're absolutely right. The economies that at the moment have to bear the greater impact, the higher costs from energy imports, even when you think into the economies and the countries that they are commodity exporters, energy exporters, at the moment we're navigating a very particular event where it's impacting not just the price but also the quantity and the ability to export, no matter the demand out there. So it just changes the paradigm. But again, when you're thinking about sensitivity, you would be regionally put it more, trying to be more wary of the places of the MENA region and perhaps into the Asia region where you have energy importers.
Well, let's come back to this point of whether it's time to buy the dip now or if there'll be more outflows, Alina.
Buy
How
the
much
dip,
worse
buy
does
the
it get
dip.
for EM if this becomes a longer war and the dollar story just keeps on continuing to get stronger?
Well, by the way that you stated the question, is exactly what you were referring to. If we get into prolonged, even intensification of the developments that started at the back of end of February, you would have been seeing risk coming under pressure, no matter which facet of risk you're thinking. And yes, you're absolutely right. And we had some outflows registered over the past few weeks. Again, it's coming at the back of a very strong beginning of the year, at the very strong last year. And naturally, if we're turning into a more risk-averse world, EM is not going to be immune. That's a fact.
Okay, Alina, thank you for your insights this morning. That's Alina Theodora Kopoulou, Emerging Markets Debt Portfolio Manager at Manulife Investment Management. Well, pivoting to the corporate world now, the Chief Executive of HSBC says he's ramping up the integration of generative AI into the lender's operations. In an exclusive conversation for Leaders with Francine Lacroix, the podcast, George Elbahary talked about the technology's impact on productivity.
Internal productivity tools that materially improve their capabilities of reading documents, reading emails, writing documents, emails, creating, changing. And 170,000 of our employees, soon over to 200 plus thousand employees. But for the moment, that's in the rollout phase. We've already reached 170,000. Of course, I will be monitoring usage, I will be monitoring super usage. Those will be the most among their countries to drive the utilization. But utilization is not optional because that's how people remain very relevant in the future workforce 5 years down the road. So using Gen AI in wealth, we're using Gen AI in markets, we're using Gen AI in contact centers, we're using Gen AI, of course, in technology. Now 30,000 of our technologists, engineers are enabled with Gen AI. The speed at which we're able to patch for, say, code weaknesses, vulnerabilities is 10 times faster already now with coding assistance than was the case last year. 10 times. We're not talking 12 months. We're not talking some productivity in 5 years. We're talking productivity already here. We're already 10 times faster at identifying and patching some of these vulnerabilities down the road. This is a huge transformation. So you can imagine how important it is. Now I go back to the first part of your question, Francine, is what are the skills that I need to the bank? I would say there's no one particular skill that's going to be critical, but
Yeah, that not. Creators is not copyright free. Look for a playlist. Okay, now how to get. Hello. Bye.
Pick up the pace with some high-speed bikes.
Hello. Guys, this ought to scare me. This ought to scare me. So I guess it as we're in this one, other setup doesn't look like we are coming anytime soon. It is the only one we have to play with for now. And it's looking bad a bit right now, like very bad. So I know the outcome that we end up seeing, but updates you get later. For now, it seems we're going to stop this live stream. It's been too long, so that's what we're going to do. And so if there's any updates, maybe the trade end up going back, well, yeah, I'm going to come back live. But if I don't come back, just know that that's it. That's all. So that's all for today, guys. If you're taking it and watching this stream, as you see the service here, you could just drop it a bit lower a bit. We can have enough breathing space because we don't know what can happen later on. So that's basically it. CP ask yourself, so probably around there. Access probably around the max. That's 462. So that's it. Well, for now, guys. Back later and I'm update on how it end up going. Yeah.